So certainly this time around, the expectation was that they wouldn't raise interest rates, they wouldn't cut interest rates this meeting, and they didn't. So the vote was 7-2 to maintain the rate at 5.25%. That's the highest it's been for almost 2 decades. So it stayed there, and of course it wasn't unanimous. And if we look at the history of bank rate, it's pretty much at the average where it's been since 1694, the median at least. So high by recent standards, but not by historical standards. And you can see how aggressively it was increased and how it's been plateauing since. So generally, the thing which I think really surprised people, market participants, as well as the Monetary Policy Committee, was services inflation. Now, of course, the price of goods in the UK is now falling, so there's deflation in the price of goods. But if we look at services, which remember is a much more important part of the UK economy, we export a lot of services, but of course we depend on services internally, makes up about 80% of the UK economy. Services inflation remains very sticky. And remember, that's also driven by wages. So it seems as if what people call second round effects, where there's some kind of shock, in this case energy initially, and also a supply chain bottleneck, creates a spike in inflation, and then that creates kind of aftershocks in the economy. One of the transmission mechanisms for that is that people have to pay more for their goods and services, so do companies. So workers demand higher wages and companies demand higher prices for their goods and services. And in this way, inflation becomes entrenched and you get this price wage spiral, but also second round effects via companies. And that's what the bank, at least some of them, think is happening, these second round effects, which is keeping services inflation high. And we'll dig into the data for this in a minute, but it does seem as if that's the case, and that's what's keeping services inflation high. Overall, though, of course, we just got the CPI numbers this morning in the UK. Inflation, the headline rate, which includes volatile components like food and energy, that's fallen to the bank's 2% target. So essentially, if you thought that that's all they did, wait till it's 2% and then we'll lower rates. Well, no, because what they have to do is to ensure that it stays at 2%, not just for that headline version of inflation, but also core inflation, because that strips out food and energy prices. Why do you strip those out? Well, that's actually a better predictor of where inflation will be in the future if you strip out the volatile components, whereas CPI inflation, including those components, tends to be much more variable. So there's more attention focused, I think, on core CPI, and that remains pretty sticky. If we look at the reasons why inflation fell, headline inflation, a lot of it was due to food prices falling. So this is why core wasn't so affected, because we've stripped out those food prices, which were pushing headline inflation down. Recreation and culture also falling. In fact, if you look at the total number of components here, only 2 of them were pushing inflation upwards. And these were due to indirect increases in energy prices. So, of course, transport's affected by energy prices, and so are housing and household services. And if we compare with the rest of the world, certainly the UK is now at the bottom of the table of developed markets in terms of inflation. So what was happening was that the delayed effect of energy price changes made England or Britain, it made us later to the game. So inflation spiked a little bit later than the US, but it also fell more slowly because of the price cap moving. That kind of delayed the fall in the UK. But now the energy prices are giving their full force to the downward year-on-year change. And the Bank of England, for this reason, expects that inflation in the UK has now kind of temporarily bottomed out. And then towards the end of this year, it's going to increase again. And again, we'll see that in a moment. So that's the overall situation. that's their decision. And of course, they don't do a press conference unless they publish a monetary, unless they publish an update to their monetary policy document, their monetary policy summary. And of course, this time around, they didn't have a monetary policy report, so they didn't have a press conference. Now, the Fed always does one, and I think they probably should, but still, there wasn't one this time around. So let's go to the actual summary of the minutes. So the minutes are what they publish, and I'll just go through the highlights of that as well, because that's really all we've got to go on. So, one moment, and I'll just scoot through my notes. Okay. Right. So, the global economic conditions. So, start off with that. The real reason I think why, even though inflation was at 2% and they didn't cut, is that they really have to get inflation down to 2% sustainably over the medium term. That's their remit. And the worry is that it's going to jump up again. And if monetary policy isn't restrictive enough, then that surge could be considerable. And what they don't want is for inflation to surge again and then suddenly have to raise rates again after they cut it just once, because that makes them look less credible. So I think that's what they're trying to avoid, the ones which did decide to keep policy restrictive at least. And it's also probably worth mentioning that the composition of the MPC is about to change. So, for example, one member of the committee is going to leave. So that's going to be, let's see, yeah, we're going to lose, who is it? Yeah, so Dave Ramsden was one of the dissenters. Swati Dhingra was another dissenter. They wanted to cut straight away this time around. Ben Broadbent is going to be replaced with someone called Claire Lombardelli. And apparently she's a bit of a hawk, so she wants to keep rates high, apparently. So that, at the margin, is going to keep rates higher for longer. Market participants, certainly at the moment, are expecting that there's going to be a cut. They didn't expect one this time around, but they think there's going to be a cut in August. The odds of that, according to the market, if you back it out of the swaps market, is roughly 50-50 for a cut in August. At least that's the expectation at the moment. But of course it's driven by data as well. So if inflation runs hot between now and then, obviously that would change the story. Services consumer price inflation was higher than projected in May, and that was of course 5.7%. And according to the MPC, that was due to index-linked or regulated prices. So maybe it's just due to a technicality that services inflation was high, but it was high. And yeah, so really what they're worried about is that kind of medium-term target and achieving it. And the monetary policy outlook, one of the interesting things at the moment, one of the drivers of the initial shock, of course, was oil and natural gas prices increasing. Now, what's pretty worrying is that oil and natural gas prices have increased recently again, and also global shipping costs have risen because of disruptions in the Gulf. And so if that's the case, then it could be a secondary blip in inflation caused by that. And as we saw in the monthly data, the only two components which were driving inflation higher, headline inflation, were due to energy effects. So it's best to keep an eye on that one. And there's a little bit of talk about the US and unemployment rates. Certainly the unemployment rate in the UK has ticked up a little bit, but it's still at historic lows. The same is true in the US, of course. The unemployment rate there increased to 4% in May, but if you look at non-farm payrolls, that's actually been very strong. So there's some conflicting data from the US on that. But overall, if you compare us to other countries, as I said, the UK's inflation rate is now at the bottom of the pack, which is a welcome change. For a long time, we were lagging other economies in terms of a fall in inflation. Of course, that doesn't mean that prices are falling. If you look at the cumulative change in prices, we're about 28% above where we were in 2020. So, of course, people are still having to adjust psychologically to higher prices, even though the annual rate is slowing down now. Overall, GDP growth was a little bit stronger than expected. It was 0.6% in Q1 of this year, and that was due to government services output and a stronger market sector output. So, the economy is not in incredible shape. It's not growing as strongly as the US. It certainly seems to have stagnated for a long period of time after the pandemic, but it was a little bit stronger than expected. And monthly GDP was unchanged in April, of course. That was the big political thing, because obviously with a re-election coming up, hopefully, for the Conservatives, not going to happen. It's going to be Labour. Then, they would have wanted a stronger GDP growth. They would have wanted stronger GDP growth, but that's not what we saw. Just no growth at all in April. But that was due to business services offsetting weakness in other sectors. So, there's overall no change. And the bank staff have revised their Q2 GDP growth forecast to 0.5%, which is a little bit higher than it was previously. So overall, the economic activity was affected by things like the weather in April. For example, we always blame the weather in the UK, and that reduced household consumption because it actually reduced retail sales because of the bad weather. We don't shop if it's raining, apparently. There was a comment which is kind of interesting, talking about the election and how that affected the decision. It's interesting, just looking at Slack in the community, at the PensionCraft community, they were talking about the election and they thought that actually it probably did affect the decision. But according to the Monetary Policy Committee, this is what they actually said in the minutes. The committee noted that the timing of the general election on 4th of July was not relevant to its decision at this meeting, which would as usual be made on the basis of what was judged necessary to achieve the 2% inflation target sustainably in the medium term. So clearly they're pointing out, actually, we didn't care about the election at all. But make of that what you will. What else is worth saying? Well, there was a kind of dissent, which is interesting. And the dissent was really about whether these second round effects were really important or not, or whether it warranted keeping rates higher for longer. Because if you want to get rid of these second round effects, if you want people not to demand higher wages, you have to perhaps have a more restrictive policy for longer. But according to the minutes, there continued to be a range of views amongst members about the extent of accumulated evidence that was likely to be needed to warrant a change in bank rate. So how much evidence do you need? And the degree to which incremental information was leading them to update materially their assessment of inflation persistence. So there's a question about stickiness. How sticky is inflation after all? And also about persistence. On the one hand, continued unwinding of past shocks to the energy and imported good prices might moderate the extent to which employees and domestic firms would seek higher nominal pay and domestic selling prices to recover the reduction in real incomes they'd experienced in the past. So if you've suffered a reduction in your buying power as a worker, then you want to recoup some of that. And one way to do it is to demand higher wages. And similarly, if you're a company that suffered a fall in margins, you'll delay the demands, or at least you'll carry on wanting margins to stay high for longer because you have to recoup some of the losses you made during the inflation spike. So that's another mechanism for this kind of second round effects. And there were disagreements in the committee about how persistent those effects would be. So that was kind of interesting. That's one of the reasons why there was a bit of dissent this time around. What else did they say? Yeah. That's probably enough, I think, about the minutes. Those are the interesting bits I found. I'm sure something else will crop up in the questions. But overall, no surprises to the policy rate decision. And if we look at mortgage rates, for example, they've kind of gone up. They've gone up again recently. So people who are hoping for a fall in mortgage rates have been disappointed. And I think there's probably a lot of anger about the Monetary Policy Committee's fixation on the 2% medium-term target. And the question is, how much evidence are they going to need that inflation's now under control in order to reduce rates? I bet those people with large mortgages are thinking, well, we're there, cut rates already. But anyway, a lot of the members of the committee, 7 of them, thought there isn't sufficient evidence yet. So that's where we are. So do ask a question. Do like and subscribe. And if you're interested in joining our community, you can do that. You just go to our website, pensioncraft.com/membership, and you can join the discussion. Tell us what you think about the idea that it's a politically motivated decision. A lot of people were saying that. It's kind of interesting that it would be blamed on politics if they did cut rates this time around. They were trying to help the incumbent party, the Conservatives. Personally, I don't really buy it. I think they probably do focus purely on the economics, and politics would really not factor in their decision. I don't really believe that, but certainly a lot of people do. So anyway, yes, do ask questions now. I will summon my cockapoo while you deliberate about which questions to ask. We do have some questions already, actually, which I will answer in a moment. I'll just summon the dog first because he gets really agitated. He has to come up and have a treat. But I will get around to the questions. Yeah, so Super Chat, obviously, that helps us financially. Please do Super Chat if you have a question. We'll push your questions to the front of the queue. There you go, Ted. And look, he gets treats because you give us small payments with the Super Chats. Very good. You're about to choke. It's only tiny. Oh, you should do a trick. I'm giving him things for free here. Come on, you have to earn it, mate. You have to earn it. You have to earn it. Hey, don't put your paws on me. Just stand. Oh, very good standing, Teddy. Clever boy. There we go. And now he'll go back to Laura. He's listening already. Can we hear Laura rattling the biltong if she hasn't eaten it herself? Did Laura eat it? Did she? Did she raid your biltong? Go on, you find Laura. She's down the stairs. Come on. He's reluctant to go. I think there's been a raid on the biltong. Did she? Oh no, he's off. Right. Yeah, so do Super Chat and we'll push your question to the front of the queue. And if you're one of our supporters on YouTube also, we'll push you to the front of the queue. Ideally questions about policy, monetary policy, but look, if you want to ask about investment, that's fine. And the first question is from BLH Low. Nice to see you there. I know who you are, but I won't read out your name because I suspect you may not want me to. Hi Roman, I used to work in the UK for a short period of time, but now I'm back to my own country and as a result have a defined contribution work pension with Legal and General. The default option was to invest 60 UK, 40 global, a 16 times UK overweight versus the global index. As a result, UK has a weighting of 12% in my total portfolio. I'd like to rebalance, reduce my overall UK weighting to be in line with a global index. But given the current low valuation of the UK market, cheap for many reasons, exclamation mark, versus the high valuation of the US, yeah, okay, so I think there are various ways to do this. I mean, it depends on what funds you've got at your disposal. One way to do this is you could just, if you have to have that holding, so if you don't have a choice of whether you sell that Legal and General fund, which has a huge UK overweight, you could just dilute it with a global index, or you could buy single regions to balance you up to the market cap weighting. So that's one way to approach it. So if you can find regional funds, you don't need that many. Let me just find the funds I've used in the past, which may help you. Yeah. So if you do want to do a kind of regional portfolio, you can do it with one of these. Yeah. Here we go. So I'll share this with you. All right. So I did this on Trading 212, but it's not necessarily to do with that platform. So 4 funds can reproduce a global index very easily. So roughly 50% US versus, and that's using this accumulation ETF from Invesco, SPXP, and then about a 30%, 27% in this European fund, of which 20%-ish is UK. So presumably you'd want a pure European one to substitute there to offset your UK balance, your UK overweight. EM would make up about, I'd say about 10%, but this is 14, a little bit too high. And then Japan would be about 12, I'd say, but here it's 9. I actually did these weights to match Life Strategy 100 as closely as possible. So you can always tweak these, but this is how you could adjust your regional weighting to kind of offset the UK balance. And what you could do is go to Just ETF and find an ex-UK European, Europe ex-UK. It's brilliant for finding these funds. And I always sort by expense ratios. So S&P Europe ex-UK, the fee is 0.09. But it's not the only fund. There's an LNG one, again 0.1. So these are very cheap funds because it's a liquid, developed market. So very cheap to trade for the fund manager. Or there's a Vanguard FTSE developed ex UK, but that's global, of course. Well, it's DM ex UK. So if you wanted Europe ex UK, there are 2 funds to choose from there, ETFs. This one's an accumulation one, which I'd probably prefer. This one's distributing, so it pays out an income. The X-Trackers one. Anyway, so that's one way to do it. The ticker for the LNG one is LGEG. And yeah, Just ETFs is a brilliant website for finding ETFs to do a particular thing. So you could substitute that one for the Europe one, and that way you could come up with something which is kind of balanced and offsets the other one, which is got the crazy UK overweight. Look, personally, I'm overweight the UK at the moment because of the cheapness, and I think there's going to be a bit of a turnaround. I think it's a long time coming, but I think it will improve in the UK, the stock market returns, because a lot of things are improving. Inflation's falling, growth isn't as bad as we thought, so that's an encouraging thing. I don't expect anything amazing, but just not as bad as is priced into the equity market. And if we did improve our trade relations with Europe, which Labour apparently is going to try and do, that would be positive for UK growth as well and UK companies. So overall, it looks like we've got more political stability coming in if Labour wins. And we've also got an improvement economically. And so who knows, with inflation falling, stability, more business investment maybe, and certainly the policies will help a little bit towards growth, but I've got very low expectations about that, given the size of the spending changes. And let me just show you the Many Happy Returns podcast that we did on this very topic. Many Happy Returns podcast. Here we go. And this is the episode Michael and I did. And it was called Will a Labour Government Be Good for Investors? So that was the topic. And I also did a YouTube video about the manifesto, which Michael liked. He said it was a good one. So unusual for him to praise the videos. But yeah, that's our podcast about it. So I hope that helps, Helen, in terms of rebalancing your portfolio. Next question is from Matthew Dick, who says, with Hargreaves Lansdown potentially being bought by private equity, considering moving my stocks and shares ISA to trading 212, that's interesting. Any downside? And it's under 50k, the portfolio. Well, there's a lot of upside, which is lower fees probably. If you have a stocks and shares ISA on trading 212, there's no platform fee, there's no commission fee. The only fee that they charge is a transaction fee for currency exchanges, and compared to other platforms, they're quite competitive. It's 0.15% to convert your money to other currencies, which is pretty good. Some of the others are just extortionate. So I think, you can avoid that altogether by buying sterling denominated funds. If you're in two minds about whether an ETF is sterling denominated, just look it up on the London Stock Exchange and you'll see whether it trades in sterling. People get confused because it actually says the fund, the base currency is in dollars. That's often the case, but it actually trades in sterling. So it's always worth checking that. My fund, for example, the one in my core portfolio is VHVG. And if you look on the professional version of Vanguard's website, it says USD in the title. And people mistakenly think that's because it trades in USD. It's not. It's because the base currency of the fund, which we never really care about, is in dollars. But anyway, you can check on Ellis, the London Stock Exchange, whether that's the case for your fund. But, is there any downside to moving to trading 212? I don't think so. It's a very big platform now. It hoovered up funds during the pandemic. And, obviously we've been doing advertisements for them. And I wouldn't do that if I didn't think it was a good platform. So, yeah, I think trading 212 is reasonable. It'll almost certainly be cheaper than Hargreaves. It hasn't got anything except for ETFs, so that's one problem. So if you wanted to buy single bonds, single gilts, that's currently not available on Trading 212. And but other than that, it's got single stocks, it's got ETFs, it's got investment trusts, all the usual choices. And personally, I like it because I think things like the pie feature is incredibly useful. I've recently started creating single stock or single fund pies because if I've got an income fund, I turn it into an accumulation fund by just reinvesting the dividends in the pie. So it's a pie with one slice, if you like, just one fund. You switch on dividend reinvestment and it becomes an accumulation fund, which is great. So that's one of the features which I like. And you can also now have a credit card with it, which is quite cool, where your general investment account starts to act like a bank account, and you get cash back. You can use it in cash machines, so it's quite cool, very innovative, compared to Hargreaves, which is showing its age, put it that way, and not great for fees, keeping them low. So yeah. I think there are very few downsides. There was a thank you. So thank you very much. Anton Vinichenko, thank you, who's done a super chat. He says, this kind of impartial commentary and explanation should be part of Bank of England communication strategy. Yeah. Thanks, Roman, for doing a public service. Thank you. I just think if they did do press conferences after every meeting, and of course that's the direction that the Fed has moved, the Federal Reserve in the US, to be more communicative, and effectively their policy, their transmission of their policy becomes more powerful, because if they can convince people to understand, at least if they can make people understand what they're doing, then the changes they make will be more effective, because more people will understand it and more people will believe that they can actually control inflation. It's kind of like believing in fairies, if you clap your hands, if you go to one of these, am I starting to ramble now? I am, aren't I? Will I start talking about electrocuting sharks in a moment? But certainly it's about belief. You've got to believe the central bank is effective, and if you believe that, then it will be effective. And that's why surveys are so important. There is actually an interesting thing here which I wanted to share with you, which I forgot. So I wonder if I can find it again. But essentially it was about the survey, the MAPS survey. Yes. Here we go. So what the Bank of England does, it actually has something called the Market Participants Survey, where they speak to people presumably at investment banks who work in finance, and they say, what do you think is going to happen to inflation? And certainly all respondents to the bank's latest Market Participants Survey, MAPS, expected bank rate to be left unchanged this meeting. Respondents had all continued to expect the next move to be downward, and the median profile had implied a cumulative 50 basis point reduction in bank rate this year, starting in August, although this was down from 75 basis points in the May MAPS. So clearly the sticky inflation has convinced the market participants that the path is actually getting shallower. There'll be less cuts because of the stickiness of services inflation. Yeah, so that's kind of interesting. Anyway, it's called the MAPS survey. And this is how the Bank of England figures out what's going on in people's minds, so it can understand these second round effects. Although, as we saw, there's still disagreement within the Monetary Policy Committee about those second round effects. But anyway, thank you, Anton. That's very kind of you. Okay. There's a follow-up from Helen from BLH Low. They say, "Hi, Roman. Thanks for answering my question, but I actually want to know if I should rebalance my total portfolio at one go or phase over a period of time." So you do have control over it. With these rebalances, unless there's a cost of rebalancing, which could be due to capital gains if it's outside an ISA or a SIP, it could be due to transaction costs. Those are the reasons why you delay doing the rebalance. But if you're just swapping equity for equity, there's no huge change in asset allocation, then the risk profile is similar and there's no reason to delay, I'd say. If that's where you want to go, because unless there's a good reason not to, there's no reason to delay. And those reasons would be costs usually. So I'd say, yeah, just do it. Because if that's not where you want to be, then a quick move is probably better. Because the way to think of it is always, you can't control the past, you can control the future, and the sooner you move to that new stance in your portfolio, the better. And generally the way to think of these things is to be stateless. They often say that the best traders, if they lose $1 billion yesterday, or if they made $1 billion profit, it makes no difference to today. Every day is a clean sheet of paper, and that's the way you should think. You can control the future, but not the past. And don't be state dependent. Don't think about the past, because it is kind of irrelevant. You are where you are. Oh, and another question, also from BLH Low. Are you concerned about the narrow breadth of the of the US market? Funny, I kind of slipped there. It was kind of like a justifiable slip. Let me just show you why. UBS. So this is the UBS Global Investment Returns Yearbook. Used to be the Credit Suisse one, now it's UBS. And it's a point about concentration, which I found really interesting. It's a great report. It's just amazing. Let me pop that up on the screen. Right, and move my face. So their point is, okay, the US is concentrated, no question. Compared to history, it's very unusual for 10 stocks or whatever to make up 30% of the S&P. That is unusual. But you compare the US with the rest of the world. So it's a bit tricky to read this one. So the 10 largest stocks, just look at the grey boxes for now, the total. So this shows you what percentage of the total market is made up by the 10 largest stocks. So for Japan, it's 20%. For the US, it's now 30. It's now 30. For India, it's 34. For the UK, it's 36. For China, it's 40. Canada, 50. Australia, 53. France, 56. Germany, 57. Taiwan, 58. Of course, they've got the big semiconductor company. In fact, yeah. That's why 40% is just the 3 largest stocks. A lot of it is just due to one stock there. Korea, 60%. So overall, the US is not as concentrated as all those markets. So we always complain about the US because it's such a big dominant market. And yet we never complain about Australia or France or Germany or the UK being so concentrated. So all I'd say is, take it in that kind of context. But certainly by US historical standards, yeah, the US is concentrated. And the other one, which I love from here, it shows the size of the US market relative to the rest of the world. And in fact, the US has made up 50% of global equity markets pretty much since 1930, for 100 years. So if you're not buying global equity because it's dominated by the US, well, you wouldn't have bought equity for the last 100 years. In fact, sometimes it's gone up to like 70% of global markets. That can't be much less than 70 in the late 1960s. So if anything, the US concentration now is not particularly high. It's just kind of in line with historic averages. So I think these kind of historical analyses are always helpful because they do contextualize the world in which we find ourselves, and we can see how unusual it is. So am I worried about the breadth of the US market though? I think I am. Concentration risk is never good. But if you have a global index, well, okay, it's going to contain a lot of those mega cap tech stocks. It's going to contain lots of Nvidia, Microsoft, Apple, and all the usual suspects. But it'll also contain 40% of the world which is outside the US. So, for a global investor, I don't think it's such a problem. If you're just investing in US stocks, yeah, I think it's more of a problem. But it wouldn't stop me from investing in the US. I still think that, they're in pretty good shape. Their valuations are high, but not ridiculously high, as they were in 2021. Now a question from Gavin Lawrence, who also super chat. Thank you, Gavin. And Gavin says, personally short the FTSE 250. Oh, 3 times short. Okay. That's surprising. Labour bad. Hello, Ted. There we go. So Gavin is kind of short the UK mid-cap index, the FTSE 250. Remember, the FTSE 250 is the kind of the more domestically driven index. The FTSE 100 is very much mega caps. Well, not mega caps. We don't have very big companies in the UK, but it's large caps, which are usually multinational, which aren't really driving a lot of their revenue in the UK. Whereas the FTSE 250 is more revenue is driven by the UK. I think it's about 50%. Overall, the FTSE 100 derives very little or surprisingly little of its revenue in the UK. So what Gavin's done is to go 3 times daily short FTSE 250. So he'll make a profit if the FTSE 250 falls. I'm not so convinced this time around. Like, markets are forward price. They kind of price in information about the future. And it's pretty much a done deal that Labour's going to win this election. You should never say never. But if we look at the latest election polls, Laura's downstairs grinding her teeth saying, don't say anything political. Okay, I'm guessing. So here we go. There we are. So this is the latest poll data from, this is from the BBC website. So there's a poll tracker. And Labour are currently at 41%, Conservatives at 21%. So there's still this 20 percentage point difference. The losses from Labour and Conservatives are now going to Reform UK. So that's been the beneficiary. And the Liberal Democrats have also had a tiny blip. But most of the movement has been towards Reform UK, the no longer Brexit party. And yeah, so I still think that it's pretty much a foregone conclusion that Labour are going to win. And markets realise that, right? They see the polls and they price in what they see. So I think that the fact that markets are pushing all-time highs, the FTSE 100 at least, suggests to me that actually I wouldn't expect a big sell-off if Labour wins. They say they're going to be business friendly this time. Who knows? But at least that's what they say. Certainly I think the leadership believe that. Whether the rest of the party will believe that, we'll have to see. That's usually the sticking point, right? When you have fractures in the party due to the leadership saying one thing and the backbenchers saying something else. So we'll just have to see whether that's the case this time around, or whether it's a real reform in the Labour Party. But interesting. And Ted says hi as well, I'm sure. Do like and subscribe. Let's see if we've got any more questions. How are we doing for time? 44. So let's say another 15 minutes and then we'll stop, depending on whether you've got any questions. Yeah. Oh, we've got another super chat. Didn't make it into the document yet. Just let's see if I can see that. Yes. So Rajasilan Ganeswaran, I hope I said that right. Rajasilan Ganeswaran says, based on experience, what happens when Nvidia fades? Well, the thing is, if you go back in time, you may not even recognize some of the stocks which have pushed up the S&P over history. And that's because there's a continual rate of change in the indices. The way I think of these, indices is kind of like a relay race in which a baton is passed from the current winners to the next generation of winners, and there's a continual churning. There's a kind of creative destruction where there's a kind of dynamic equilibrium, to use a biochemical phrase, where the current leaders which push up the index are changing all the time. And that's natural. Society changes, the things we buy, the things which are popular. At the moment it's AI. I'm sure it'll be something else in 10 years' time. That's what pushes up stock prices. And eventually what happens is the leaders fall back. IBM was the kind of incredible stock of the 70s. Nowadays it's just a kind of plodder. Other examples would be steel companies. Those were the hot tech companies in the 1930s. So successful, in fact, that they had to be broken up. Companies like AT&T in the 70s, incredibly successful, again, had to be broken up by the government. So, the overall winners change. And I wouldn't sweat about it, because if you are an index investor, who cares? There's a lot of churn going on under the surface. As long as something's pushing it up, and it is usually just a tiny handful of stocks, remember, the average stock underperforms the index. It's just a handful of super outperformers which pushes up the whole index. We don't care. As long as that continues happening, we're fine with it as index investors. If you invest in single stocks, different story, because you'll have probably a concentrated position. And if there's a reversal of fortunes at the top, it could be a problem for you if you've got that exposure. So I think this is just another example of why you might want to be an index investor. Dabble in single stocks, sure, but don't make that a big part of your portfolio, because your chances of choosing the winners is not particularly high. It's fun to try, but you probably won't succeed. You will learn and you'll have fun doing it, but I don't think that single stock selection is likely to work. So I hope that answers your question, Rajaseelan. But thank you for the super chat. That's great. Let's just check for anything else. Let's do a couple of the non-super chat, non-supporter questions. I'll scoot down to the bottom. What factors are relatively cheap? Interesting question. I mean, I don't usually think of factors as being cheap. Countries might be cheap. So China, very cheap. And cheap for a reason, of course. And that's the problem with value investing, which is that there's always a reason behind the low valuation. The important thing is not to go into value traps. So buy turnaround stories. So if you can combine value and momentum, that's usually a much better combo, because you're buying something which is cheap currently but on the rise, and you're going to filter out things which are cheap currently but still on the downward trend. So that's the kind of style which I think is more likely to succeed. Or in my what I've got on, let me share this. What I've got currently is, I mentioned that I've got a UK portfolio. Let's just have a look at it. It's this one. Yeah, let me share that. So this is a portfolio I made in order to just kind of play around with single stocks. So this is in my fund portfolio. And this is currently a filter which I'm using. They're called screens on Stockopedia. But the way this works is I'm looking for high quality stocks which are value stocks, but also which have positive momentum. So the rank on all three of these is greater than 50. So they have a ranking which puts them above half the market in all three cases. Plus they're small caps with a market cap between 100 million and a billion. And my new filter, which is liquidity, because what I didn't want is to end up trading a stock where the bid offer spread, the difference between the buy and selling price, is crazily big. So if it's more than 5%, I exclude it. I had a stock where the bid offer spread was 23%. So that's the difference between the buying and selling price. So to sell my position would have just lost all of my gains. So I'm still stuck with that. I'm going to have to take the hit at some point, but not yet. So that's the way this works. So what I've done is I've chosen two from each sector, two industrials, two consumer defensives, and so on. And the portfolio I came up with was this one. So these are the stocks I've got. And the stock ranks when I bought them were all, above 90 or, above 85, I think. One of them has started falling. It's the illiquid one, of course, JZ Capital Partners. But the rest are all pretty high. And when these fall below about 70, I'll probably sell them and swap them out with some other stock. This one I've already want to swap out. And this is a pie in Trading 212. So, yeah. But this is, this is my approach, which is to combine factors. And in your case, maybe you'd want to combine value with momentum. But I've also added quality and small cap to my filter, and that's how I constructed this portfolio. But yeah, that's what I constructed, and that's what I'm kind of playing around with. It's been good fun. It's actually made some money, which is pretty shocking, despite my rebalancing and losing a lot of the alpha early on. I've learnt my lesson. How are we doing for time? We've got 8 minutes. Let's do some quick fire questions. Hasn't France and the CAC 40, the CAC 40 plummeted? Rise of the far right in Europe is fascinating. Yes, the French have really fallen. One of the consequences of that was that the UK market is now bigger than the French market, and there were so many headlines about this, as if it was a huge victory for the UK. Although all it really means is that we're both small equity markets, which are kind of vying for nth position in the global tables. So that was, I thought they were quite funny headlines. I didn't really read a lot into it. But certainly France, yeah. Let's have a look at the CAC 40. It's kind of tanked recently. Let's fire up Stockopedia. No. Let's fire up SharePad. And cross-asset indices, which is one of the things I use for our newsletter, which we publish every Friday. Cross-asset benchmarks, here we go. CAC 40 chart, webcam, lovely. Here we go. So I've overlaid here, accidentally, MSCI World, and you can see the little blip recently. So if we look at return, instead of price, which is more interesting, you can see the recent fall. So the MSCI World, that's developed markets, has gone up since the 14th of May, and the CAC 40 has shot itself in the foot. It's blessé in the pied. I don't know how to say that in French. But you can see that's fallen by 8% and it's still falling. So yeah, clearly populism doesn't work well with markets, because the policies that go with it probably would not be good for the French economy. That must be the thinking. And probably not good for trade either. So, what would those policies be? Reduction in immigration, which usually weakens growth, increases costs for companies, reduces margins. Also a reduction in trade, maybe more protectionism. All of this stuff from the populist playbook sounds good when you try to peddle it to the electorate, but you can't fool the economy and you can't fool the bottom line with a company. You can live in this kind of imaginary world in which these things are good, but when truth hits, it's not going to be pleasant. So companies know that, and these are the consequences of those choices. So yeah, I think it's pretty shocking. But it's not France alone which is seeing this shift to the right. You also see it in Germany, Hungary. That's been the case because people are disillusioned with politicians. Maybe it's the effect of high inflation. Maybe it's the effect of immigration and all of the crises which we've had, which lead to resentment because people leave those countries and try to seek asylum in the West, and you get resentment, pushback from the population. But whatever the reason, markets probably are not going to like the consequences, which is a shift to populist politics and worsening of the economy. So we'll just have to see whether this thing works its way out of the system in France and things improve, or spiral out of control. At the moment, at least, it is contained to France. It's not kind of bleeding out into other countries. So if we look at Germany over the same region, there's no total return for Germany because the DAX is already a total return index, unfortunately. See if I can find a Eurostock. Euronext 100. No returns. Let's get a price. Yeah, so Euronext has been affected a little bit, but not as much as France, obviously. And the UK, not affected at all. So, yeah, we'll just have to see if this spills out more generally. So we haven't got any more super chats. I think I'll draw a line under it there. Thank you all for joining us. I think in August we're going to do another one of these, obviously. We'll talk about what the Bank of England's done. No changes this time around. Probably will be then. We'll just have to see what happens to the data. It's data dependent. Do subscribe. Please do look at our community. PensionCraft.com/membership. You can find out more there. If you want one-to-one coaching, I do that too. PensionCraft.com/coaching. You can find out more there. And do listen to our podcast, free. It's Many Happy Returns, where Michael and I talk about investment and economics. And people love that because it's quite informal. So thank you all for spending this time with us, and I hope it was helpful. And we'll speak again, particularly about the Bank of England in a month's time. And take care, everyone, and good luck with your portfolios.